Never let a winner turn into a loser. Protect your capital at all costs. Move your stop to break even as soon as possible. We hear these rules every day. They are the golden commandments of risk management. They make us feel safe. They make us feel like we are in control. But logic and probability are not always the same thing. I wanted to test the mathematical validity of this rule specifically for the ICT Silver Bullet strategy on the Nasdaq. I didn't run a small test of 50 trades. I ran a comprehensive algorithmic backtest covering 2,097 trades on the M5 time frame. The goal was to establish a baseline. What happens to the raw expectancy of the strategy when we mechanically apply a break-even rule? The results were stark. The difference between holding the trade and protecting it wasn't just a few dollars. It was the difference between a highly profitable system and a losing one. First, let's look at how this data was generated. I didn't open TradingView and scroll back manually. Manual backtesting is flawed because we unconsciously filter out bad trades or assume we would have felt the market turning. Instead, I wrote a Python script to execute the Silver Bullet strategy mechanically. To ensure accuracy, let's define the parameters of this study. We are analyzing the ICT Silver Bullet AM session on the Nasdaq. The algorithm selects the first fair value gap that allows for an entry. Note that this could be an FVG formed prior to the window or inside the window, as long as the entry happens during the session. The target risk-to-reward ratio is fixed at 1:2. This is a standard target for this model. This is important because we are establishing a baseline. This is how the strategy performs in its rawest, most naked form. We tested two mechanical approaches on the exact same dataset. Approach A. The control group. We enter at the fair value gap. We set a stop loss and a 1-2 take profit. We do not touch the trade. It either hits the target or the stop. Approach B. The variable group. We enter the same way. However, if the price covers 50% of the distance to the target, essentially reaching 1R, we mechanically move the stop loss to break even. It is important to note, this script does not use daily bias or news filters. It is a blind robot. This allows us to isolate the performance of the break-even rule itself, independent of market context. Let's look at the control group first, leaving the trade alone. Out of 2,097 trades, this approach yielded a net return of plus 261R. Now look at the win rate, 37.48%. To a beginner, 37% might sound low, but mathematically, at a 1-2 risk-to-reward ratio, you only need a 33% win rate to break even. At 37.5%, the system is printing money. The expected value per trade is positive. Of course, a 37% win rate means you lose more often than you win. This creates psychological pressure, and this pressure is exactly why traders rush to move their stops to break even. They want to artificially boost their safety. But here is what happens when we apply that safety mechanism. Approach B, moving to break even, resulted in a net loss of minus 63R. The most shocking data point is the win rate destruction. It dropped from 37.48% down to 18.5%. Think about what this means. Roughly half of the winning trades in the control group actually retraced to the entry point before hitting the 1-2 target. The safety of break-even turned 20% of our winning trades into nothing trades. And in a game of probabilities, deleting 20% of your winners is a death sentence for your equity curve. In Approach A, we weathered that storm and secured the 2R profit. In Approach B, we were stopped out for 0. The break-even rule didn't just prevent losses, it aggressively filtered out winners. By trying to eliminate risk, we inadvertently eliminated the edge. Why is the drop so severe? We are trading the Nasdaq on a 5-minute time frame. This asset is known for aggressive liquidity seeking and high volatility. When aiming for a 1-2 target, the price needs time and room to breathe. A retest of the entry level, or specifically the fair value gap, is a normal part of price delivery. When you move to break even mechanically at 1R, you are placing your stop loss exactly where the market often returns to rebalance before the real expansion occurs. You are essentially asking the market to move in a straight line, which the Nasdaq rarely does. Does this mean you should never move to break even? Not necessarily. It means that doing it mechanically is statistically flawed for this specific setup. As a discretionary trader, you have an advantage over this Python script: context. If you see the price rejecting a higher time frame array or taking a target, moving to break even might be wise. But if you are moving it simply because it's a rule or because you are uncomfortable with the open risk, the data suggests you are likely sabotaging your own expectancy. The baseline data is clear. For the ICT Silver Bullet targeting 1 to 2, the cost of mechanical protection in this simulation was 324R. The strategy works best when allowed to breathe. If you want me to backtest any other specific strategy or ICT concept using Python, let me know in the comments. This is quant logic. Trade based on data, not dogmas.